Hello, my name is Balaji Nedurumalli, and this is a presentation for the Finance 695 course for the MBA program at Southeastern Louisiana University. And in this presentation, I would be discussing one of my proposed investing strategies, and then I will pursue to prove it and see if it works. So you might be wondering why I called it the art of investing. Well, there's one simple reason. There is no foolproof method of picking stocks. There is no way to predict the market accurately. I wish we all knew there was a way and we can make it some science, but unfortunately, you have to master the art, and which is the only way you can maximize your gains out of the market. Why is it an art and not a science? Well, the aim is to pick a stock that will give a rate of return more than the market. That is how you invest. You want to beat the market, or at least go in par with the market as long as the market is progressing in a positive direction. It is not a science, obviously, because there is no formula to determine the company's future based on its past performance. Well, you can look at, for example, Blockbuster. It was performing all right until there was this disruptive technology came on board like Redbox and Netflix, and there was no way, or the Blockbuster was not prepared to actually handle this sort of a disruptive situation. So such variables cannot be predicted, and you should always try to evaluate multiple variables. Without further ado, let's go to the next point. It says there are intangible assets and variables that cannot be measured, like staff, reputation, company, and loyalty. You look at Apple, for example, the loyalty keeps it going. Emotions affect the market when confidence turns to fear. Let us say there is an instance or an incident that happens with the company that would strongly affect the confidence of the stockholders, and they might start selling it off. And maintain discipline and diversify your portfolio across industries, which is a good way to reduce the risk of your portfolio. So this is a point that I've always considered. Younger investors can choose more aggressive investments in growth companies or young companies that have high potential to grow at the same time has high risk involved. And people who are older and approaching retirement may want to consider investing on a fundamental basis. There are some general strategies I would like to expose y'all before I get into the my personal strategy. There is value investing, where the investor would look at the fundamentals of the company, which is the intrinsic value, and which is real value of the company against the stock price reflected on it. So if you look at a stock with low P to E ratio, more than likely it is undervalued. But again, it's not a one reason situation here. You want to look at more variables before you conclude such a theory. And next is growth investing, where you want to invest in companies that are aggressively growing. So these stocks typically are priced higher than the intrinsic value, which is the real value of the company. And there is a rule by the NAIC that says the growth rate of 15% is preferred, because if you calculate 15% growth, consistent growth would mean the stock price doubling in 5 years. And mostly young companies come under this category. So there's the third type, which is called income investing. And a lot of people invest in stocks with high dividends because, as you know, dividends are sticky and guaranteed. And regardless, I wouldn't say regardless, you definitely want to look at the stability of the company alongside the dividends, because dividends is certain income, almost certain income. and at the same time, you don't want the company to go bankrupt and your principal getting lost. So you want stable companies with high dividends. And also be aware that high dividends can cause problems when the money paid for the dividends has better value in reinvestment, because there, right there, you're losing some economic value in case that that money paid for dividends was rather reinvested in the company, which could have elevated the stock price. Right. Now, regression analysis. I'm sorry, my strategy. My personal risk profile allows me to be a growth investor, so I'm looking for stocks of growth. In the interest of time, I'm going to jump to regression analysis, which is the technology I used using an Excel, where I selected the 10 companies from the other project, and I did a statistical significance analysis to prove that there's a relationship between the price to P to E ratio and the growth and the beta. So here, as you see, I have used the X variable as P to E ratio, and the Y variable, I used two variables here, growth and beta. So regression analysis, I want to evaluate the p-value, where the p-value of less than 1 or less than 0.01 implies that the data is statistically significant, and that I can there is some sort of dependency between the variables. So this is the data, and I just want to run a quick regression analysis on my data. And as you see, the p-value right here is 0.0546, which is way more than what I would expect it to have, which means there is not much the data or the beta and growth variables are not statistically significant with respect to P to E ratio. So in conclusion, the p-value for both variables happen to be greater than the statistical 0.01, which means they're not statistically significant, and there does not seem to be a correlation between P to E ratio. So I would not recommend just looking at P to E ratio if you're investing in growth stocks, and do look at other variables also. This might be relevant for some stocks, but not everything. And always, more the variables you consider, the narrower the risk gets. Right, thank you very much for looking at my video.